Welcome back to another episode of Market Brief After Hours. It has been a turbulent week, to say the least. We are looking at a classic double whammy: geopolitical instability driving energy prices through the roof, and simultaneously economic data that suggests the labor market is hitting the brakes much harder than anyone anticipated.
It really was the perfect storm for a sell-off. You know, investors hate uncertainty, but what they hate even more is stagflation, that dreaded combination of slowing growth and rising inflation. And looking at the data from this past week, that is exactly the narrative that is starting to keep money managers up at night.
Let's dive right into the numbers, because the damage on the U.S. charts was significant. We saw a broad retreat across the board. Walk us through the damage on the major indices.
It was ugly. The sentiment just cratered at the end of the week. Starting with the S&P 500, we saw it slump by about 1.33%. In terms of points, it settled right at 6,740. Then you look at the blue chips. The Dow Jones Industrial Average posted its steepest weekly decline in a full year. It lost 0.95%, closing the week at 47,502. That pressure was really coming from the industrial and consumer discretionary sectors, which makes sense when fuel costs are eating into margins and disposable income.
And the tech sector. Usually they are sensitive to interest rates, but this week it felt like a general risk-off sentiment.
Absolutely. The Nasdaq Composite took the biggest hit of the three. It dropped 1.59%, closing at 22,388. When you have growth concerns mixed with inflation fears, those high-valuation tech stocks are often the first to get trimmed.
Now, the catalyst for all of this seems to be the energy market. We are seeing moves in crude oil that are frankly historic.
Historic is the right word. We are talking about a record weekly surge. Because of the escalating conflict in the Middle East, specifically the U.S.-Israel conflict with Iran, the fear premium is back in the market with a vengeance. U.S. West Texas Intermediate, or WTI, jumped over 12% just on Friday alone to settle at $90.90 per barrel.
And for the week?
For the week, WTI soared 35.63%. That is the largest weekly gain since oil futures trading began in 1983.
That is incredible. Since 1983?
It is unprecedented volatility. And Brent crude wasn't far behind. It climbed roughly 28% for the week, settling at $92.69. That's its strongest weekly advance since April 2020. When energy costs spike like that, it acts as a tax on the entire global economy, which brings us to the other side of the coin, the jobs data.
Right, because usually you might think a strong economy could absorb higher energy prices, but the payroll report dropped a bombshell.
It really did. The expectations were already low, looking for a modest gain of 50,000 jobs. Instead, the U.S. economy actually lost 92,000 jobs in February. That is a massive miss. We also saw the unemployment rate edge up to 4.4%, and the labor force participation rate slipped to 62%, which is the lowest level since December 2021.
So we have shrinking payrolls in manufacturing, transportation, and federal government employment. It sounds like the softness is widespread.
It is, and this complicates everything for the Federal Reserve. Usually, if the economy slows, they cut rates. But if oil is pushing inflation up, they can't cut rates easily without risking a price spiral. That's the stagflation trap.
Let's look across the Atlantic. I assume the energy fears hit Europe just as hard, considering their proximity to the conflict and energy dependence.
It was a sea of red in Europe. The Pan-European Stoxx 600 fell 1% on Friday and ended the week down about 4.6%. That is its steepest weekly decline since April of last year.
Run us through the major country indices.
Sure. In the UK, the FTSE 100 dropped 1.39% to close at 10,269. Over in Germany, the DAX fell 1.22%. Italy's FTSE MIB was down the same amount, 1.22%. France's CAC 40 slipped 0.7% to 7,994, and Switzerland's SMI lost 1.52%, ending at 13,096.
And the economic backdrop there isn't helping much either, is it?
It's mixed. Euro area employment actually rose slightly, beating expectations, but annual economic growth was revised down to just 1.2%. That's the slowest expansion in over a year. So, similar to the US, you have slowing growth colliding with rising energy costs.
Before we get into the currency markets and some specific stock movers, let's take a quick break. Welcome back to Market Brief After Hours. We've covered the equity sell-off and the oil shock. Now I want to pivot to Asia because there was some extreme volatility there, particularly in South Korea.
That was one of the wildest charts of the week. The South Korean Kospi surged 9.6% to close at 5,583.9. But you have to view that in context. It had plunged 12% the previous session.
That is whiplash territory.
It is. Strategists are saying this rally was driven largely by a reversal of leveraged selling and margin calls, rather than any sudden improvement in fundamentals. Elsewhere, Japan's Nikkei 225 rose 1.9%, though it still ended the week down significantly. And in China, the CSI 300 climbed almost 1% after Beijing set their 2026 GDP growth target at 4.5% to 5%.
Which is remarkably low for them, historically speaking.
It is the lowest target in decades. It signals they are really focusing on managing deflationary pressures rather than chasing explosive growth.
Let's get technical. For our listeners who trade Forex, the charts are painting a very specific picture right now. Let's start with the euro against the dollar.
The euro USD is in a tough spot. It closed at 1.1607, down slightly. But the story here is the moving averages. The pair is trading below the 50-day SMA at 1.1765, the 100-day SMA at 1.1695, and the 200-day SMA at 1.1669.
So it's below all three major averages.
Exactly. That signals persistent bearish pressure across multiple timeframes. It's making lower highs and lower lows. Unless it can break back above that 200-day average at 1.1669, the path of least resistance is down towards 1.1500.
What about the British pound? Cable has been a bit more resilient lately.
A little bit. GBP USD closed at 1.3393. It's in a consolidation pattern. It's hovering right near its 100-day SMA, which is at 1.3398. However, it is still positioned below the 200-day SMA at 1.3445 and the 50-day SMA at 1.3532.
So it's sandwiched?
It is trapped. It's moving sideways. Immediate resistance is that 200-day line at 1.3445. If it can't break that, we might see a retest of support near 1.3352.
And finally, the loonie. The Canadian dollar usually loves high oil prices. Did we see that correlation hold?
We certainly did. The USD CAD plummeted 0.65% to close at 1.3585. Remember, when oil goes up, the Canadian dollar strengthens, which pushes this pair down. It smashed through support levels. It is now trading well below its 50-day SMA of 1.3706. The daily candle was decisively bearish, closing at the session low. If it breaks below 1.3585 comfortably, we are looking at a move toward the 1.3500 psychological level.
Let's touch on commodities. Gold and silver often act as safe havens during geopolitical strife. Did they shine this week?
Gold absolutely did. It closed at $5,152, up 1.32%. The bullish trend is fully intact here. Price is well above the rising 50-day SMA of $4,956, the 100-day at $4,604, and the 200-day way down at $3,985. It's a classic buy-the-dip structure with higher highs.
And silver?
Silver is playing catch-up, but rebounded strongly, closing at $83.86, up nearly 2%. However, technically, it has a bit more work to do. It is still below its 50-day SMA at $85.20, which is acting as immediate resistance. But it is holding above the 100 and 200-day averages, so the long-term structure is still positive.
Moving to digital assets. Usually when risk appetite disappears, crypto takes a hit. Was that the case?
Yes, crypto faced selling pressure along with the Nasdaq. Bitcoin slipped more than 4% to around $68,097. It fell back below that psychological $70,000 level. Volume declined, and it just couldn't sustain the momentum. Ethereum dropped over 5% to $1,979, and we saw similar declines of 4 to 5% in Solana, Cardano, and XRP.
Before we wrap up, let's look at the individual names making waves. We had some big winners and some serious losers this week. Let's start with the good news.
The standout winner was Marvell Technology. Their shares surged 18%. This is purely an AI story. They reported strong quarterly earnings driven by robust demand for AI infrastructure.
It shows that even in a down market, the AI narrative still has legs.
And Boeing, they've had a rough year, but they popped this week.
They did. Boeing shares climbed 4%. Reports came out that they are negotiating with China for a massive order of 500 aircraft. If that deal goes through, it's a huge stabilizer for their order book.
Now for the not-so-good news. Retail took a hit.
The Gap tumbled 15%. They reported comparable sales growth of 3%, which sounds okay, but it completely missed analyst expectations. In this environment, if you miss, you get punished.
And in healthcare?
Nutex Health plunged 14%. They reported a surprise quarterly loss that missed consensus estimates by a wide margin. Investors don't have patience for surprise losses right now.
And finally, a big name in finance, BlackRock.
This one is concerning. BlackRock shares fell 7%. They had to move to limit withdrawals from their corporate lending fund because of a spike in redemption requests. When the world's largest asset manager is gating withdrawals, it makes the market very nervous about liquidity.
It certainly does. So to sum it up, oil is at record highs, U.S. jobs are disappearing, and markets are sliding. It feels like next week is going to be crucial.
It will be. Investors are going to be hyper-focused on two things: the headlines coming out of the Middle East regarding energy supply, and any further data that confirms whether the U.S. economy is just cooling or freezing over. The central banks are in a very difficult position.
We will be watching it all closely. That brings us to the end of this edition. If you find this useful, please follow Market Brief After Hours on your favorite platform. Have a great weekend, everyone.